Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about FISERV INC quarterly report. FISERV Inc. offers a wide range of businesses and services, including merchant acquiring and digital commerce services, mobile payment services, security and fraud protection solutions, stored value solutions, software as a service, SaaS, pay-by-bank solutions, Clover point of sale and business management, platform debit card processing services, debit network services, bill payment services, person-to-person payments, account-to-account transfers, credit card processing services, prepaid card processing services, card production services, print services, government payment, processing, student loan processing, customer loan, and deposit account processing, digital banking services, financial and risk management services, professional services, and consulting, check processing, automated clearinghouse, ACH, services, real-time payments. These services cater to various clients, including large enterprises, small businesses, banks, credit unions, fintech companies, public sectors, and software providers. FISERV Inc. stock price crash. A year of turmoil in a shocking turn of events. FISERV Inc.'s stock price plummeted by a staggering 66.99% in the past year, primarily triggered by a series of negative news events surrounding its third quarter 2025 earnings report and strategic announcements. The company's disappointing Q3 2025 earnings and revenue significantly lowered full-year 2025 guidance, major leadership and board shakeup, ongoing federal securities class action lawsuit, slowdown in key business segments, and decision to transfer stock listing all contributed to the drastic decline. The combination of these factors led to a 47% drop on October 29, 2025, marking one of FISERV's worst trading days ever. The company's inability to meet analyst expectations, coupled with its reduced guidance and leadership changes, raised concerns among investors. Furthermore, the ongoing lawsuit alleging inflated growth figures for its Clover payments platform added to the negative sentiment. The slowdown in key business segments, including a significant drop in operating margins, also weighed heavily on the stock price. As FISERV navigates these challenges, it remains to be seen how the company will recover from this tumultuous year and regain investor confidence. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in processing and services revenue by 4.3% from 2024 to 2025 contributed significantly to the overall growth. Additionally, product revenue saw a substantial rise of 25%, further boosting the company's revenue. Acquisitions, such as Payfair and CCV Group BV, also played a crucial role in driving revenue growth. The expansion into new markets and geographies, including Europe and Asia-Pacific region, helped to tap into untapped customer bases. Furthermore, the deployment of Clover POS and business management platform enhanced capabilities and innovation. The company's embedded finance capabilities were also increased, allowing for expanded payment and financial service offerings for partners and clients. This strategic move contributed to revenue growth across various segments, including small business, 6.7% increase, and enterprise, 4.2% increase. Overall, these factors combined to drive significant revenue growth for the company. For net income and profit margins, a shift in performance. The financial performance of a company has undergone significant changes between 2024 and 2025. Net income has increased by $445 million in 2025, with a notable 40% surge in the 3 months ended September 30, 2025. However, this growth is not consistent across all periods, as seen in the 19.9% increase for the 9 months ended September 30, 2025. Profit margins have also experienced fluctuations. Operating income margin decreased by 3.4 percentage points to 27.3%. While net income margin increased by 4.2 percentage points to 15.1%. The reasons behind these changes are unclear from the provided data, leaving room for further analysis and investigation. The company's financial performance indicates a strong ability to generate cash from its core operations. With an operating cash flow of $1,472 million as of September 30, 2025, the company is successfully converting profits into liquid assets. This positive trend suggests that the business is financially stable and capable of meeting its obligations, positioning it for future growth and success. The company's debt level and interest expenses have undergone significant changes. The total liabilities increased by $4.7 billion, from $49.5 million to $54.2 million. Long-term debt also rose by $5.1 billion, from $23.7 million to $28.9 million. Furthermore, the short-term and current maturities of long-term debt saw a notable increase of 19%. The interest expenses have also seen a substantial rise, with a net increase of $96 million in the 3 months ended September 30, 2025, compared to the same period in 2024. This trend continued for the 9-month period, with an increase of $246 million. These changes can be attributed to several factors, including the issuance of new senior unsecured multicurrency, revolving credit facilities, and the repayment of commercial paper notes using senior notes proceeds. The company's financial performance varied across segments and regions. The merchant segment performed well, with a plus 5% growth in Q3 and plus 7% growth in 9 million. In contrast, the financial segment experienced a minus 3% decline in Q3, but improved to plus 3% growth in 9 million. Regionally, the U.S. generated the majority of revenue, while EMEA, LATAM, and APAC contributed 16%, 15%, and 15% respectively to the total revenue for both 3 and 9 months ended September 30, 2025. Management is optimistic about the company's outlook, highlighting several key strategies for growth and improvement. The company plans to adopt new income tax disclosure requirements and expand its embedded finance capabilities through acquisitions. It will also accelerate the deployment of its Clover POS and business management platform across various regions. A multi-year transformation program, One FISERV Action Plan, has been launched to prioritize client focus and drive growth. This plan focuses on 5 strategic pillars: client-first mindset, building a preeminent small business operating platform, creating differentiated platforms in finance and commerce, delivering operational excellence enabled by AI, and disciplined capital allocation. The company expects to remain compliant with debt terms and will use operating cash flow to fund various initiatives, including investments in new technologies and processes. Overall, management is committed to driving growth and improving efficiency through strategic investments and initiatives. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. Acquisitions have been a key part of the company's growth strategy. Notably, in 2019, First Data Corporation was acquired, resulting in an ownership interest in WFMS. Additionally, in the third quarter of 2025, AIBMS was acquired for $252 million, giving the company a 49.9% ownership stake. On the other hand, divestitures have also played a significant role in the company's evolution. The joint venture with Wells Fargo expired on April 1, 2025, resulting in an initial cash payment of $453 million. Furthermore, a joint venture agreement with a merchant alliance was terminated in June 2024. These transactions demonstrate the company's ability to adapt and evolve through strategic acquisitions and divestitures, ultimately shaping its business for future growth and success. The company's financial summary reveals that it has engaged in share buybacks, indicating a strategy of returning value to its shareholders through the repurchase of outstanding shares rather than distributing dividends. Concerns about inventory buildup and supply chain disruption. The financial summary highlights several indicators suggesting potential issues with inventory buildup and supply chain disruption. The increase in cost of processing and services as a percentage of revenue, 34.8% versus 31.8%, on page 44 raises concerns, while the rising cost of product as a percentage of revenue from 69% to 62.6% in Q3 2024 and Q3 2025, respectively, indicates potential inventory management issues. Additionally, residual payments to channel partners increased, which may indicate some level of inventory or supply chain management problems, on page 47. These data points suggest that further analysis is warranted to understand the extent of these concerns. That concludes the financial summary for FISERV INC. Feel free to comment below, and I will be happy to answer them when possible.